All right, everybody. How's it going tonight? Welcome to West Side Real Estate Meetup. Glad you guys could join us tonight. West Side Real Estate Meetup is hosted by WNN Properties. One of our biggest assets is time, so time is one of our most valuable assets, and I just want to thank you all for joining us this evening. And before we begin, I want to disclose that this meeting will be recorded and posted online so you can watch it if you missed it. So if you missed some parts, then please feel free to share it with your friends. We also encourage everyone to join our Facebook group at Westside Real Estate Meetup and our email group at westsiderealestatemeetup@gmail.com. The email is mainly used to send out reminders for the meetups and other events hosted by WNN. For those of you new here, my name is Gilbert Coloma. I'm one of the co-hosts tonight for this meetup. I am, like most of you, I do have a W-2 job. Starting to get my feet wet in real estate investing. I am implementing the BRRRR strategy in Kansas City, Missouri, in hopes to, one day retire sooner rather than later. So it's the plan. Alongside me, we have Brandon Robbie, who's also a co-host, and Young Park, who will be introducing our guest speaker tonight. One more thing is we will be having some breakout sessions right around 8 p.m. tonight. So please stick around if you can. In those breakout sessions, we'll basically break out into smaller groups to share what we learned, and most importantly, network. That's what I found out in my real estate investing journey here. Networking is huge, so please stick around. Here's Young.
All righty. All right. Thanks, Gilbert. Yeah. So again, my name is Young. I'm one of the co-hosts for the Westside Real Estate Meetup. I also am a buy and hold investor investing in the Kansas City market. And like many of us here, I am a full-time employee or worker striving to achieve financial freedom so that I can spend more time with my wife and the loved ones and be able to support my parents financially. I currently have 4 properties, and I actually just got under contract on a new property this week. So I'm super excited about that. It'll be going under inspections next week. So I'll decide then whether I want to pursue that property or not. And another exciting thing going on for me is that I'm actually working on a delayed financing with our guest speaker tonight. So yeah, I'm super excited about that. Yeah, so tonight, as you guys already know, the topic will be on refinancing and some traditional lending options. And we'll have our guest, Mike Arrieta, here tonight. Some of us had the opportunity to listen into his presentation before, and it was so informative and it was so good that we actually reached out to him, within a couple of days to be our next speaker. So we're super excited to have him here. I think you guys will really enjoy this tonight. So yeah, there will be a lot of information. So if you somehow missed any information or you want to share the information with your friends or refer back to it, this will be posted with a YouTube link. So that should be sent out in probably about a week or so from now. So yeah, please share it with your friends. And now I would like to bring in our guest, Mike. Before I do, I want to tell you guys a little bit about himself, about Mike. So Mike is a VP of lending with Guaranteed Rate of Honolulu. His clients trust him as their mortgage consultant because he provides great service, communication, and low rates. Coming from a sales background, Mike learned he never wanted to push products on his customers to meet goals, but wants what's best for his clients. He prioritizes helping his clients understand their options and guiding them through the process. His favorite quote from a satisfied client was that his customer service skills are impeccable. He loves to educate them so they can make an informed decision. And he's originally from San Francisco Bay Area. and he relocated to Hawaii in 2013. It was here that he met his wife, Alexandra, and they have been married for 6 years and are blessed with 2 boys. He is also an active real estate investor and loves to help fellow investors towards financial freedom. So without further ado, let's bring in Mike. What's up, Mike?
Yeah, thanks, man. Appreciate it. That was a very long.
Yeah, super excited to have you.
That was cool. Great to be here with you guys. Thanks for letting me come on, and awesome to see all the familiar names that I know from WNN, some past clients. Jeff, Katie, today was a big day. So awesome on that. So really cool to be able to talk. I love talking to investors. As Young said, I'm actually in lending today because of investing. I love being on the journey with you guys. I'm in the same boat as Young. I'm growing property base and portfolio. And so I get to turn my passion in investing with lending and help other folks do that as well. So it really is a passion of mine. You guys probably know even more and different things that I don't know as investors. So I love, seeing you guys, what you guys do, getting inspired by it, even just taking on your wisdom. Ellard, I see you down there too. We've had some chats. I got to glean some more stuff from you. So really cool to be able to network and get to know you guys. I'm excited to see how this goes. So yeah, I wanted to share my screen here. Let me know if that pops up for you. So today, yeah, like as Young was saying, I really just want to give maybe a highlight or overview of how lending can work in your portfolio as you grow your basis of your properties. Now, whether you're a novice investor or whether you're experienced and maybe not even mortgageable anymore, you've gone past that threshold, there is still a good bit of knowledge that maybe you can benefit from here, even if it's not for yourself, but maybe for something that you're actively doing. So what I want to do is just highlight the different ways that traditional lending in this case, can benefit your investing strategy. So I'm focused more on the conventional side today. I'm not going to tap into the commercial side. We're talking residential property. So I'm not thinking like anything like storage or syndication or seller financing. Those are more the creative side of investing. As you guys know, it can go a ton of different directions depending on what you want to focus on. But at least for today, as far as a lender full-time and investor part-time, eventually I want that to flip. But today as a lender, I want to talk about just the traditional ways that we can finance and help you. Some of the highlights, I'm going to go over each of these categories, right? Everyone can see that okay? My screen showing, can you give me a thumbs up? Awesome. So different ways it can fit in with your investing strategy, depending on what you do, whether you're local in Hawaii or out of state, maybe it's different seasons or whatever your focus is. These are the different ways that it can fit into your strategy, right? If you're buying turnkey property, it's performing, got a tenant in there, it doesn't need much work, put a traditional mortgage on there to acquire the property. The BRRRR method, if you guys are familiar with that, you buy it in cash, fix it up, rent out, refinance, pull as much of your funds back as possible. Even if you're going to flip a property, so this might be a little bit different. If you're going to buy it in cash and then just sell it, maybe you didn't think about that. Traditional lending actually could apply to you too. So we'll talk about that. And then house hacking, if you're in that stage of life, you want to use an owner-occupant loan to buy a property, and either with multiple units or just different rooms, and you want to use that as rental income. We'll talk about that as well, okay? And then if you guys have questions along the way, I know Young and Brandon Gilbert are going to monitor the chat. Feel free to throw those up. I'll try to, or maybe put up in the chat. If I get to it and stop during this, we'll stop at 30, 40 minutes and we'll go over that as well, okay? And I can always go back to these slides if you want more information. So don't feel like you have to get all of this down. My main goal today is informational in the general sense. None of this is committal. This is my disclaimer. This is not a commitment to lend. This is not like definite terms. Whatever I quote here could change tomorrow, right? As we know, especially with the last year, guidelines change left and right. So this is as of today, this is accurate, but the goal here today is to drive conversation, help you plan for your next project. And if you want to talk numbers or things specifically, I would talk to your loan officer, talk to me. I'd be happy to run numbers for you and see how we can make it work for your next step. But yeah, the main goal here is drive conversation, and help each other out with, our past experience too, to help us all grow together. All right. So just some quick stuff about us, Guaranteed Rates. This is our scores, how we do across the board, as far as we are a top 10 nationwide lender. We have, I think, 7 in Hawaii. If you didn't know, there's 3 on Big Island, 1 on Maui, and 3 here on Oahu. So we have 7 local branches, and we are nationwide. Our base is out of Chicago, and we actually have a huge base here in Hawaii as well, with local processors and underwriters, and then some of our accolades there. Some of the main things that we can do. So if you think of traditional lending, it's one of 2 things, right? It's either you're purchasing or you're refinancing. It's simple. You're either going to buy a new place or you're going to change the current loan on your current place. And that's what all it comes down to. Now, the discrepancy could come into what type of occupancy, if you're going to live in it, if it's an investment, or if it's a second home. So we can do all of that. We can do different government loans. We can do conventional loans, different types of properties, PUDs, condos. You can do co-ops, 2 to 4 units, modular homes. And then we are nationwide. I'm personally licensed in the states here: Arizona, California, Florida, Hawaii, Kansas City, Missouri, Nevada, Oregon, Texas, Washington, more to come. But that's where I'm personally licensed. So if you have any needs in those areas, or know people that want to invest in those areas, if you want me to help you with a certain state, I would be happy to get that license for you. It's kind of like on a need basis. I had a client that got PCS'd out to Washington. He wanted to get a loan out there. I got licensed. We just helped him move as his family is moving their duty station. So we do I do a broader spectrum besides investing, but my passion is investing, and that's what our topic is today. So technology, we've got a good platform for tech, as we had to have, but we were also the world's first leading digital mortgage. We had a platform where you can apply in 10, 15 minutes and get credit, bank statements, all that stuff pulled up, get approval. You can start shopping in 10, 15 minutes. You can also upload documents directly. So very easy and feasible, efficient for online and the world we live in today, when you're meeting on Zoom and seeing only people's faces this big. We're great for that. So we'll help you out. And even flash close signing, do most of it online. Hawaii, we do have to get a notary to come and just wet sign some docs, but most of it can be done online. And your in-person notary can be as fast as you want, really. If you want to ask more questions, take more time, but in and out, 5 minutes, notary's got you done, send your docs off. A little bit about me, as Young said, he gave his background. So for me, just to kind of recap some of that, I started out of high school as a wholesaler. I was crawling into houses, taking pictures, crawling in windows and vacant, not people's houses they lived in, vacant houses, to try to wrap it up, tie it up, get the estimate on the rehab, and take pictures of it, package it up, get it under contract, find the owner, sell it off. That's what I was doing straight out of high school. Real estate sales, I spent some time there as well. Personal banking, and then rental car sales here on the airport, enterprise with the airport. I've been a lender for 6 years. I am an active investor, and when I'm not doing all that stuff in the wee hours of the day, I also spend time with my family. That's my wife and our 2 little boys, 2 and 9 months, I think he is. Weightlifting and a church life. So most recent deal, I just closed on this one last week, a duplex in Kansas State. This is a hybrid BRRRR. So I had a single family property that I sold to someone on this call. This is pretty cool that you're on here. And I did a 1031 play to this property. I used a cash partner for the difference. And we're going to, right now we have the vacated side is being upgraded. We're going to push that up, market rent, get that in, stabilize it, and then work on the other side that's not as performing. I'll put a HELOC on there, and then we'll renovate the other side. So we're kind of getting ready for the other tenant, which has more work that needs to be done, and we'll flip it and then basically save the income for that side to renovate that one. So we got it at 174, should be a fair market value of 200K. So I do understand, the goal of this. I love leverage. I respect your what's his name, Dave Ramsey, right? Cash is king. I believe in the power of leverage, good and bad debt. Use debt to buy new debt that offsets that one and grows your portfolio. When you get to your 10 max mortgageable properties, pay them all off, put mortgages on them again to buy another 10 new properties. I believe in the power of leverage for sure. So let's talk about some ways to get an investment loan. Okay, so before we get to the strategy, what does it take to get a loan? Some good information to know. Okay, so you want to start, or you want to get your next property, you want to get your first property, you want to get an investment loan on there. So what are you going to need to get started? The rule of two. Okay, if you guys aren't familiar with this, just think of the rule of two. I need, as far as documentation, I need my most recent 2 years of tax returns and W-2s. That's federal only. I get a lot of Hawaii state tax returns. I just immediately just take that out, but it's fine. Send it, just send the whole thing if you need to. So 2 most recent tax returns, W-2s, 2 most recent pay stubs, whatever encapsulates 30 days, and then 2 most recent bank statements. I'll put an asterisk on that. If you have multiple properties, we might need more to see reserves, depending on how you do it. But that's just a general rule of thumb. Just think rule of two, 2 tax returns, 2 pay stubs, 2 bank statements. That's what's going to get us a good bit of headway onto what your qualifying is. Okay. Along with that, we will need a loan application, right? So you're in the system, we can look at everything and we can see the snapshot of your financial picture, your credit report. So we know the debts and we can analyze that. And then once you have a contract or you're started on your refinance and appraisal, and we'll talk a little bit more about how that has changed with COVID recently. If you have additional properties, really crucial now that you're going to need the most recent mortgage statement. The underwriters are checking for forbearance. If you had to, defer payments for a little bit, it's required that that is paid and caught up before you can close on a new loan. So they do check for that all the way through closing. So just fair warning, okay? Insurance policy, the tax bill, an association statement, if that applies. If it's Hawaii, you're probably going to have an association of some sort. Hard to find. You do have them. Talk to your association manager. Send me that statement that I don't ever see, but where I pay $500 a month and it just goes off somewhere. You do need to send that so we can see how much you are liable for a payment on a certain property if you're in Hawaii. Okay. So here's some recent changes that might be good to know if you haven't been following, if you haven't done anything recently, or maybe you just didn't apply to you, but good to know some recent changes with investment loans. Okay. So Freddie Mac, Fannie Mae, they diminish the amount of investment loans they want to buy. So the criteria has just been dwindling a little bit, what they actually will buy back. So adjustable rate mortgages on investment loans are discontinued for now. It's only fixed rate. Even with fixed rate loans, there's no more 10 and 15-year mortgages. Okay, that is no more. This was a big bummer to me. There's no more renovation loans for investment products, at least in the conventional world. That was a big hit. So I'm waiting for that to come back around so I can offer renovation loans again and appraisal waivers. So this is great for owner-occupant loans, for investment loans, to full appraisal. Okay, you got to get them to come in there, take pictures, walk the property. They want to see everything, not just a drive-by or desktop appraisal. Okay, and then some of the stuff I mentioned before, but updated mortgage statements, verbal verifications of employment. So call into your employer if you do W-2 job. They want to know that, hey, your income has not changed. It hasn't diminished at all since we started your underwriting. You're about to close. They're going to call in and say, oh, just can you clarify that? Everything is the same, nothing's changed, right? So they do want to make sure that that's there. If you have a self-employed, if you have your own business, there are additional requirements, profit and loss statements up through 60 days of the closing of your note, of your new note, profit and loss statement. If it's audited, that's all you need. If your CPA will audit that for you. If it's not audited, they want 3 months, the most recent business bank statements. They want to see that business revenue landing in your account with your business name on it. They want to know that you are stable, and we have to do a income stability worksheet as well. It's very meticulous, and especially if you own property, so all my self-employed borrowers, I give them a heads up before we start anything. It's going to be more documentation than you had a year ago, or more than a year and a half ago. So just fair warning, do it up front before you're in contract, and then timeline is important. Okay, so any questions on that, I can always work with you on that. So it's always good to know how many loans can you get. You want to plan down the line, how long can I keep borrowing and growing my portfolio with a 20% down on a loan, right? So if it's to one borrower, 4 properties. If you're in Hawaii, that's going to come quick. If you're investing out of state, that the second line could apply to you, where it's a max of 1.5 million in total finance. You could do 10 easily if you're in Kansas State, where some of us are. So 4 properties or a max of 1.5 million in total. That's guaranteed rate finance, but it's actually Freddie Mac and Fannie Mae rolling as well. So just a heads up on that. So that's where you probably want to get into your catapult strategy. You have your 4 already. Okay, get a HELOC on one of them, pay it down so you can squeeze in another one. So you have, free and clear. So you always have 4, but you're rolling it, right? Reserves is important. You need to know how much you need to plan for, because you have a down payment, you have your renovation, maybe you have your reserves in the sense of the property, right? CapEx, all that stuff you want to save ahead of time. But to close a loan, make sure you remember to think of your reserves. And this is where I could help you calculate the number if you need to. So reserves is basically the number of months of the monthly payment of this subject property that you need to have in liquid cash, right? In near liquid cash. So if your payment on this new place is $1,000 and the underwriter wants you to have 6 months of reserves for that property, that's $6,000, right? Separate from closing costs and down payment. You got to have that just sitting in a bank. They want to know that if it hits the fan and this property is not performing for 6 months, you can still make the payment. That's the goal, right? So reserves, and these are different ways that can apply, types of accounts. Basically, if you want to calculate reserves, just send your lender everything, and they'll find it. They'll make it easy on you. Just send them what they ask for, and they'll find it. They'll use what they need, and they won't use the rest to keep your file as simple as possible. There's different ways you have to calculate it depending on how far you are in your journey, how many properties you have financed at one time. So when you have a primary residence and you have 5 investment properties, okay, so maybe you have your primary residence, you have four, but now you're buying your 6th property, okay? There's a reserve requirement within that bubble that it's 2 months for each additional property, 6 months of reserves for the subject property. It's kind of confusing. Don't worry about the numbers. We'll do the numbers for you. But basically, when you're in that category, you need 2 months of payments of reserve for each property, right? Minimum FICO is 680. So, okay, just think 2 months per property, 6 months for my subject property. You don't need any for your primary, just a heads up. But once you get from 7 to 10, okay, somehow your loans are all $100,000 each, you can get to more than 4 financed properties. You're still within the 1.5 million total financed mark. So 7 to 10, it's a lot more, it's possible, but you definitely have to have you got to prepare for it, okay? So your minimum FICO is going to jump from 680 to 720. Your credit score has got to be higher. And then you have to have 8 months of reserves of payment for each property. That's a big jump. Definitely possible, but it gets a lot more challenging to do a traditional financing in that sense. Okay, so I have the calculation there. I won't spend time on it. If you have questions, just talk to your lender. Say, okay, how much do I need since I have 6 properties? I want to buy my 7th. What do I need? Okay, and remember that's excluding your down payment and your closing costs, renovation, your Disneyland trip coming up. Make sure all that stuff is prepared so you're not trying to get to closing and just liquidating everything to make your next purchase work. All right, so kind of going into each of these strategies that I highlighted before, how does investing work and how can it benefit you depending on your strategy? How can traditional financing help you, right? My goal is to help you finance your financial freedom. That was my title, super corny, but I'm sticking with it. So say you want to just buy turnkey property, you have the down payment, you don't have all the time to renovate it, you just want to buy something performing, someone's already done the work, you just want to buy it and put your money to work for you. So some new guidelines: debt to income ratios, 48.00% of your, meaning how much of your monthly income is wrapped up in a credit reported debt, right? 48% of that. That's the cap. So it used to be 45 as of like 2 weeks ago. can go up to 48%. So that's great. As we said before, terms, fixed rate is only options, 30, 25, 20 years. If you want a cash flow, most likely you're going to be in the 30-year mark, right? Longer term, shorter payment. So that's usually the way most people would go. If your credit score is at, you could actually do a 660 credit score if you still want to buy in that category, and then full appraisal required. Loan to value, how much down payment do you need? Basically, the value of the house is 100,000. Loan to value is 80%. That means your loan max is 80,000. You have to fill in the gap of the 20%. So flip it to down payment. My loan to value is 80% for a 1-unit property. I need 20% down. Remember closing costs and reserves, okay? If it's a 2 to 4 unit property like my duplex, you got to have 75% down. All right. This is something you don't necessarily need to know, but your lender will have to make sure it works on his end, is whether you own your primary residence, if you rent or if you own your current place, there's a difference with how we will have to underwrite a loan for you. If you rent your primary residence and you're trying to buy a new property, it's $1,000 monthly payment on that new property, we have to qualify you for the full $1,000 payment, okay? Even if it's rented, it's performing, it's great. You rent it at $2,000 a month, that's great. I can't use it on my application if you rent your primary residence, okay? But if you own your primary and you want to buy a property that has a $1,000 monthly payment, it's rented at $1,000. I can use that with 25% off of it. So I can use $750 of that. I'm only going to count a payment against you of $250. So you don't have to know the numbers per se, just know that it's different if you rent your primary versus you own it. Okay. No minimum loan amount. Please don't come to me for a $10,000 loan amount. Just kidding, I'll help you, no worries. But someone asked me that, so I put that in there. There's no technical minimum loan amount. All right, so that's your turnkey property. This is your cash out refinance. So there's different ways this can apply in the investing world. Quick clarification here. What is a HELOC and how's it different from a cash out refinance? So I will just say we don't offer HELOCs, but I think an investor should know the difference and how to utilize both of them. So I am talking about it here. Very important. I think both of them should apply to your strategy, your business focus as you build out. Home equity line of credit. Basically, think of a credit card on the value of your house. Your house is worth $100,000. There's no debt on it. Put a credit line of $80,000 on there, and you can max that out to $80,000 and buy something brand new, or you can put 30 grand on it, pay it off, do it again, 30 grand, pay it off, do it again. It's revolving, right? We all know that term, revolving versus installment. So home equity lines of credit, depending where you go, credit unions, different local banks, they have a program likely that could work for you. Wells Fargo, just think of your bank, ask them what their HELOC program and options are, but you can do adjustable rate, fixed rate options. You can even ask them what position. Maybe they'll do a first position HELOC. That's always good to know. Is it open end or is it multiple uses? Does it have any costs to open? Usually it doesn't. No costs to open. And then there's no appraisal typically. So a desktop or drive-by, that doesn't cost anything. One of the cons, I guess, is you're going to be, if you're capped on traditional loans, you'll probably be capped earlier on by the amount of HELOCs you can have at one time. So, normally the good rule of thumb is if you're going to buy properties in cash, try to put the first brunt of them on HELOCs as much as possible. Say they only will give you 3 HELOCs for finance properties. If you have a 4th finance property, they won't do any more HELOCs. Get as many HELOCs as you can first is my recommendation, because that's revolving. You just keep using it, right? But you can get more traditional loans, traditional home loans than you can HELOCs, okay? Benefit of HELOCs is a higher loan to value ratio. So maybe they'll go to 90%. I don't know. That's usually for owner occupants, but ask them if they do that for investment loans too, okay? So I don't offer HELOCs, but good stuff to know. Talk to your local bank or your credit union, ask them what their their options are there. Cash out refinance, I can do. So this is a one-time fixed rate, fixed term loan. And the benefit here, I'll just go down the line. Fixed rate, closed-end, one-time use. There are closing costs, not out of pocket, maybe the appraisal out of pocket, but everything comes from the proceeds of your loan. Full appraisal required, higher potential to qualify so you can do more loans with them. And then a lower loan to value. So if your credit union will do a loan to value of 80%, probably a cash out refinance on investment, 75%, right? And then take your closing costs out of that. So in my mind, do as many HELOCs as you can until you can't anymore, and then go into the fixed cash out refinance world. But again, depending on your options, HELOCs, you kind of got to stay on top of, make sure you're not getting past your introductory rate period. All right, so HELOCs versus cash out refinance there. So just to go on cash out refinances, since that's what I offer, I can talk more specifically on it. Same kind of guidelines as your turnkey. Main difference is your FICO is actually a little bit higher. Minimum FICO is at 680. Okay, so watch those credit scores. And that might not apply to investors, but one thing to consider, if you get a new loan, sometimes you're a new home loan, don't be surprised if your credit score drops, even just a little bit, right? Creditors think you just put like the $600,000 mortgage on your profile. I want to make sure you can pay that first before I give you another loan. So it might not always happen, but it happens often enough where I've had to tell clients, it's okay, just give it some time, pay your new payment, it'll reset back to where it needs to. But that's where you got to watch. If you do too much, too fast, a lot of inquiries and a lot of new debts, don't be surprised if your FICO gets lower. Just make your payments on time, keep your balances low, and it'll all come back. Delayed financing. This is where Young is the new expert. So this is a unique strategy. If I would say you're buying something turnkey, but with cash, and you don't want to do any renovations, tenants in place, maybe is a good idea. But basically you bought a property in cash and you want to just move as much of those funds to the next one as possible right away. Okay, so I don't think I actually mentioned it, but cash out refinances, I should mention this. This line, I can't highlight it for you guys. So if you bought a property in cash and you want to do a cash out refinance, right? Say you borrowed $70,000 from your private money lenders, right? Just your uncle, your friend, your business partner. They gave you 70 grand. You put 30 grand, you bought a property. So before you can cash out refinance, you have to be on title for 6 months and 1 day before we can do a cash out refinance for you. It's called a seasoning period, right? Kicker there started at 4 months so that by the time it takes 2 months for the appraiser to go in there and get all the processing, you're done by 6 months and a day. And that's like the shortest period. Just make sure your renovations are going well, but it takes 6 months of seasoning before we can do a cash out refinance for you. Okay, good to know. Makes sense with the next slide. Delayed financing, you don't have that, that seasoning period. So I don't know if I'll go into the nuances there so much, but just remember, if I have something in cash that's performing and I don't need to do any work on it, talk to Mike about delayed financing. Talk to Young about delayed financing. He is the man. He will tell you all of that. But a really good tool to know because it can fit in, right? It can work, can make your money move faster. Buy property in cash, buy it turnkey, just keep moving as much of it as possible. Same restrictions do apply. So it's 75% loan to value. So maybe the market swings enough, but there's a good chance you could leave some money in the deal because you're not forcing your appreciation, right, on your initial buy. It could be maybe $10,000 over just because the market moved. So you might get some additional money, but in this strategy, you got to be prepared to leave some in the deal. Okay. All right. So that's turnkey. That's cash out refinance. So property flipping. These are the big honchos that do the big renovation, and they just want to work for a living. They don't want to relax like the rest of us private and hold forever investors. These guys do all the work themselves and they sell it and want those big paydays. But even traditional lending can apply to your niche, to your strategy. And how does that work? So the reason being is you have to sell that property to an end buyer. How can you make sure you do your flip well? so that it appeals to the most amount of end buyers as possible, because they're more than likely going to put a traditional mortgage on that property. So the big thing I would say on that is your structural integrity. I mean, obviously you're going to try and get the most value, but it has to appraise well. So I don't just think this would apply to anyone. Make sure there's no exposed plumbing. Make sure you got permits on everything. Make sure all the wires, everything is great so it can appraise well. And a traditional lender will go and appraiser will go in there and say, yep, let's put 300,000 extra value on here than what you bought it for. But some other good things to know, they have, you can call it flip policies based on the different types of loans. So conventional loan, probably the bigger pool, they do not have a flip policy of what they can buy your property for, but the increase in sales price has to be supported by the renovations. It has to make sense. And then you must be the owner of record when the buyer signs the contract. So make sure if you're doing entities, that it's your name on the contract, okay? That says VA loans, but that's another slide. I'll fix that later on. This is VA loans. So same thing applies. The VA loan is very similar. No flip policy, same thing. Make sure that it's supported by renovations and that you're the owner when they sign the contract. And of course, VA buyers have to buy it as their primary residence. So in this case, this is where this can change. FHA loans. So as a lender, an FHA loan to me is the last resort. Someone really wants to buy, they don't want to take some time to fix credit up a little bit. And maybe they have some debts that I would recommend paying down, but they just want to buy. So it happens. People like the FHA loan. I try to go away as much as possible from it if we can avoid it, but it depends on the client. You might have an FHA buyer on your property. Just so you understand that they cannot buy your property until you've owned it for 3 months. It's just a different rule that Ginny Mae has. So if maybe it takes you 3 months to renovate the property, cool, you can get FHA loans on there. And there's different rules from 91 to 180 days. You might need 2 appraisals. The resale price, if it's 100% over the purchase price, you did a great job. They're going to require some extra stuff. So just know FHA is probably not your best friend if you're doing a flip. Look for your conventional, your VA loans. I don't know about USDA. I got to check on that. But just you're a little bit limited. So take that for what it is. But it still applies. Make sure it looks beautiful and it performs, it's structurally sound. And then I'm checking my time here. 30 minutes. All right. We doing okay? Thumbs up. Everyone following? I haven't lost anyone. Okay. House hacking. So the guys that just are adventurous, maybe you're young and you don't have kids yet, you want to do what's called house hacking. I see a thumbs up there, Tani. Thank you for that. So this is definitely for those that are in state, not out of state investors. The goal of house hacking is you want to take advantage of those owner occupant 5% down loans, and you just want to grow your portfolio that way. You're really comfortable with moving very often. Maybe you do it once and that's it, but good to know here. So some owner occupant loans, it's an excellent method to satisfy the owner occupancy requirements and build a rental portfolio. So depending on what you're looking to do, but this is where you're buying a 1 to 4 unit property and occupying as your primary residence. I don't know how common this is in Hawaii, if you can find something in the price range, but man, if you can buy a duplex or a fourplex and occupy 1 unit, rent out the others, more power to you, go for it. That's definitely the goal here. Maybe other states it's more feasible and not too much in a distressed area. But by all means, you can buy that fourplex with 5% down and move into it, manage the other sides. And then the kicker here that's good to know and to remember is you get 1 owner occupant loan a year. I've seen this happen. Just know that it can happen, but either one of 2 things can happen. Not that they will, but if you try to do 2 owner occupant loans in a year, you can get an IRS audit, or the new lender could call your other one. I guess your other one could be called due because they see the inquiry. You don't want that escalation clause to hit. Okay. So just think every 12 months, I can do a new owner occupant loan. If you're really that go-getter, you want to keep moving around, fixing up properties you live in, renting it, moving, do it by all means. Take advantage of that 5% loan, 5% down, but just know every 12 months, okay, don't open yourself up to an IRS audit. I've seen it happen. It's not pretty. Okay, another benefit here, because it's an owner occupant loan, I can offer you a renovation loan on that. So you can actually buy, put your down payment, get some additional financing to help fix up the property. So talk to me about that. And of course, moving for every new home. Once you have kids, good luck to you moving that crib, maybe even a spouse that is not down to do that. So it's a legit strategy, excellent product to do for your owner occupant loans. Good time. So I'll kind of wrap it up here. So here's just some lending myths. These are some things that I come across where I have to help people understand some of the nuance, just to know that I'm not a hard money lender. And I don't control a lot of different things that I have to help people understand. So I'll just kind of go through some of these. Maybe it helps, maybe it changes your perspective a little bit when you're approaching and talking to your loan officer. So for one, that maybe the myth is that rates are subjective. Okay, I used to work in rental car sales, and someone comes in, they have a Camry, they got for $40 a day. I can upgrade them and upsell them to like a Mustang. Maybe my manager tells me to sell it to them for $75 a day. I can play around with that as much as possible. Whatever I can get them to say yes to, I could do it for $10 a day, and it makes the company less money. But you know, that's what they wanted to do. I would drop the price and do it for them. That's rental car sales. Maybe if you want to rent your next car, talk to your agent. Say, hey, what's the lowest you can get me? They can do it. Just so you know, mortgage rates are not like that. Okay, I cannot control the rates. It is very specific. It is very unique to you and your situation and what you're trying to do. It's not based on your negotiation skills, your intellectual prowess. I've had people come across and just say, hey, give me the best rate. What if I don't know, different stuff I've had to come across. There's a set rate sheet and different things apply. So some of the things that come into play is the occupancy type, the property type, single family versus condo, the number of units, your loan amount, your state, that's all different too. Down payment, loan to value, credit score, what type of term, what's the purpose of the loan. One thing I really explain a lot is points versus rebates. If you're an investor, just think you're paying 1 point on any rate minimum. That's just how it's going to be. 1 point is 1% of the loan amount payable at closing, right? The loan amount's $100,000. You're going to pay $1,000 just for the rate itself. Okay, part of your closing costs that they disclose to you when you do a new loan, but you can always pay extra in points to get a lower rate if you want to. Debt to income ratio, that also affects rates and the market as well, as we have seen. So just so you know, your lender does not control the rates, and of course company and the margins and all that stuff too. Personally, as a lender, I opt to take less commission so I can give better rates back and just do more volume. That's my goal. I like to just not have to worry about competing on rates. So I have dropped my own rates. I offer better pricing to all my clients. Every lender is the same. They're not all the same. So think about how thorough is your pre-approval. Are all the contingencies prepared for before going into contract? Terrible thing when you're 30 days in and there's something that just blows the water out of your pre-approval and they just didn't catch it. So how thorough was that? Can you reach? This is a big one. Best rate is the one down the street, but you can't get a hold of the loan officer. How good is that? You have no idea where your loan is. Do you get regular updates on your loan progress? Okay. And how easy is it to work with your lender's platform? Can you apply directly? Can you call them anytime or at least get a text? Can you walk and just talk to them, provide documentation safely and securely? Can they give you updates regularly and even close your loan? I mean, best rate down the street, but can they get you to the closing table? Think about, just something to think about. How easy is it to use and actually get through that loan process? All right. So that's always important too. You need to negotiate with your lender. So my thing is, I want to be your guys' lender for life. I mean, I'm not assuming you don't all have to use me, but I would love to serve you all and help you with your portfolio. But my goal is to make a love relationship out of it. We're here to help you with the guidelines and help you get structured so we can get you closed, right? The lender's on your side. We're not here to get you to overpay, overcommit to anything. You don't have to hide stuff from your lender. If they don't need it, they won't use it, but you have to make the payments. It has to work with your investing strategy by the end of the day. So I'm here to be a lender for life. I want continued business. I want the business from your family afterwards. And ultimately, I want to see my clients achieve financial freedom. I had a client that wanted to buy in Hawaii and it just didn't fit, didn't fit right now. So I told her about, hey, what if you just use that money you have right now, use that for property in the mainland? That's 20%. She's down. She's actually in contract right now. So someone that wants to buy a mortgage, buy owner occupant, they've got a great place. Hey, why don't you use that to build your portfolio? So really cool to see that that's happening. I've had some clients come to me and just say, you're asking for too much. I just don't want to give it to you. I'm like, okay, I wouldn't ask for it if I didn't need it. Okay, your lender is not trying to make it hard on you. We have to go by the guidelines, and really we're working for you. It's a lot easier to give your lender what they need up front rather than parse it out over the loan, because maybe it takes 2-3 days to get one document. Now that eats up your contract time. Just give it to him up front. He can use what he needs, right? His goal is to help you meet the guidelines and just to make it easy for you. So help him help you, give him what he asks for. Don't fight back. He's not trying to, he doesn't remember all the stuff in your application. He just looks at it in the sense of an application for a specific loan, okay? It is kind of awkward to share all that stuff with someone maybe you just met. So I understand, but we're just trying to help you close on the loan. And then the last thing, appraisal values. I get a lot of times that my appraiser did this or your appraisal didn't do this. Like, I have no idea who the appraiser was. I cannot influence the appraisal in any way. It goes to a panel of pre-selected appraisers based on the company. I don't even know who they are. We don't choose them. We don't put them on there. We cannot shop and get the best. It's just who picks up the order at the time and when they go and look at the property, okay? Yeah, so some things that set us apart, just to end it off, as I mentioned, low rates, and then you do get good additional automated stuff, but I give updates as well for me and my team. So I am here to help. If you guys have questions, I'm always happy to talk story with you guys, hear your voice, hear your story, hear what you're trying to do. And I make it a goal to be accessible via text, email, and phone call, and videos like this. I send video messages out as well with updates, and my team behind me is excellent as well as pushing your loan through. So you have us all the way through the process. But that's kind of all I had. My timer didn't even go up, so that was within the parameters. So I'll cap it there, but I appreciate you guys hopefully listening. I see a lot of black screens and just names on it, but hopefully someone was there listening, was benefiting. Otherwise, it was a fun night. So I'll leave it there. Thanks, Young, Brandon, and Gilbert.
Awesome. Hey, Mike, thank you again for joining us tonight and presenting these. It's a lot of information, and you did an amazing job just providing all that information within the limited time that we have. So yeah, if you guys want to refer back to anything, again, our video will be posted in about a week or two. So just refer back to that. And I'm going to look at those example numbers with the 4 properties and 8 properties where you have numbers and how much money you have to have in reserves. So yeah, at this time, I'm gonna start going over the questions. So I'm going to start with mine because I have the mic. When you're saying near liquid cash, what are some of the examples?
Unmute. Yeah, near liquid just means it's fully vested. You can easily convert it back into a liquid account. So it's not like a stock portfolio that you have to sell and wait for the market. So here's an example here. Funds in a savings or checking account, funds in a trust account, investments in bonds, CDs, money market funds, mutual funds or stocks, retirement that's fully vested, cash value. So depending on what it is too, we can use a different percentage of it. So that's where it gets a little bit of a nitty gritty. So rather than you try and figure it out, just talk to your lender and they will run it in the system and they'll look at it and determine, yes, you have it. Maybe we need to use an extra account. We don't have enough at this time. Good question.
Got it. Appreciate that. And Tani asked, do all banks use the same desk side appraisal platform? Does the public have access to that platform to run numbers?
To run numbers as far as what it's going to appraise for?
Let's see.
Desk
I don't know,
side-
Tani, if you want to speak up.
Yeah, so I just did my HELOC, or the process anyway. And then my loan officer was like, hey, doing my desk side appraisal, your home, appraised for this much.
Yeah, it's essentially comps, right? They're just looking at the recent market data and then they adjust based on the differences in the properties. So I think it's the same numbers, but it depends on how that specific appraiser is going to tinker with it, So that's where you have a little bit of the gray area. But it's basically just comps that they look at the market data and they analyze and then make decisions of proximity and size and condition, if that helps. Hope that answered it.
Okay, thanks, Mike.
Yeah, good question.
All right. And Daniel asked, someone told me when buying a primary, you can do an appraisal waiver. Do you know anything about that?
Yes. So this is one that there are some parameters for, but we run an automated underwriting system depending on the program, and it tells us based on that specific one. So it could depend on the location. Generally, if you have, like with today, if you have 10% down, and I think for single family, I think condo might be a little bit more. But yeah, it is valid for primary residence. It's just not for investor and second home. So I want to say 10% down, but it could be more. I haven't checked in the last week. So
I mean, basically, they can just buy it for whatever price that the person is selling it for, and they can waive the appraisal. I mean, this seems very valuable as like when you're flipping a property and like the property is not going to appraise for how like the whole thing is like the people are putting the appraisal waivers, but then is there a product where you can just basically get the appraisal waived on the loan?
Oh, I see what you mean. So normally an appraisal waiver, it means they're using like the tax assessed value.
Okay, so there's some other kind of a broker's price or whatever kind of thing that they're using.
Yeah,
instead.
it's not like a gift of equity, if that's what you mean. It's more of like based on the area and the way the market's moving, it has enough of a spread where they're comfortable just not putting an appraisal on it.
I see, but
it's a good idea.
They're gonna do like their own desktop appraisal with some margin or something along those lines.
Yeah. So the good thing there is maybe they don't look at the inside of the home, and you're not dinged for that. They could drive by. They could just do it from their computer, depending on how it goes. Yeah.
Okay. Thank you.
Yeah.
And so I had one more question. I don't know if when you mentioned something about the 25%, I think taking off with it's your primary. So is it if you have a primary and you're renting out your primary, does it have to be a duplex, or like let's say you have a single family home with like an ADU, or not even an ADU, but you're renting out part of your single family home? Can you count that income towards your debt to income ratio?
If it's an ADU or no. So if you're doing an investment loan, you mean, and you have a primary residence where you rent out an ADU or a second unit?
Yeah. Can that count towards your debt to income? I mean, your debt to income ratio if it's like tighter.
Oh yeah. This one is a no. I have someone in the chat that I know we were looking at that and I couldn't use it. So there are some instances for like primary residence refinances where you can use, but the thinking there is like if something happened to your home, you're going to have to move somewhere else and that income is gone. So they think your payment's there regardless, but you might not have that rental income. So generally, if you live in the property and you rent it out, just know your lender can't use that income if you're doing an investment loan. There are some instances where you can use that, but not for investing as far as conventional financing goes.
Thank you.
Yeah.
All right. I think we have time for one more question.
I did see Blaze.
Blaze.
Yeah. That's a yes.
Yeah.
Mortgage rate alerts. Yep. You want a certain percentage. The market ticks down. It tells me, hey, Blaze his rate just came up. Give him a call. Absolutely.
All right, Tani, we got one more for you.
Sorry. I have a question. So regarding the VA loan, right? So you have what you have to stay in that property for 1 year, right? Let's say I have a training in Missouri and I go back and forth throughout the year. Does that count as my 1 year of occupancy in my primary residence?
So you basically have two different residences, but you stay in one, you just go abroad a lot?
Yes.
So the goal there, or the discrepancy, is how you bought the property initially. Whichever property you bought and put an owner occupant loan on there, they're gonna wait for a year before they give you another one. Does that answer it? Whichever one you bought and put an owner occupant loan on.
Okay, I got it.
Because that's what's reported on your mortgage and your note and credit and everything, right? So even if you live somewhere else, just don't put a loan on there, and keep all your banking stuff going to the one residence, your mailing address, so it's easier to prove. Basically, don't get a new owner occupant loan because they'll see that one. That's what they're gonna see.
Okay.
Yeah.
Okay, I got it. Answer my question. Thanks, Mike.
Sure.
All righty. Thank you, guys. And thank you, Mike, again, for presenting to us tonight. I know we could definitely ask a bunch of more questions, but since we're a little bit short on time, where can people find you to connect with you and just ask
Yeah,
questions?
I'm very accessible via text. That's the fastest way I'll get to you. Email, of course. I think Brandon had that in the chat as well. Calls for sure. I can respond to calls. If you want to Zoom like this, or the meetup, the Google meetup, that's usually a great way to connect to, talk story. So whatever works for you. I'm flexible. I'm also on Instagram and Facebook. I have a personal and a business Facebook that I've not merged yet, so I'm working on that. But I'd say text and Instagram is where I'm most active as a millennial. Good at that, I guess.
Oh, sorry. I should have been on mute when I was laughing, but yes, that's a millennial thing to do. Text and Instagram.
Yeah.
All right. At this time, we're gonna wrap it up, and I'm gonna hand over the mic to Brandon.
Yeah, sure thing. So thank you again, Mike. Really appreciate it. A lot of good info. And if you wanted to connect with Mike, if you had more questions, all of his contact info is in the chat, so you can check that out. Before we end tonight, I did want to talk about next month. So next month we got two investors that are living out of state in Nevada, I believe, Chris and Sheena Coloma. I think I've seen them here earlier. And yeah, they're still here. So next month we're gonna have them. They're gonna talk about mindset and goals, and September is kind of the ending of third quarter. So they're gonna talk about finishing the year strong, right? So next month we're gonna have them on. And just as a quick announcement too, in September, we're going to meet on the 4th Wednesday. That's September 22nd. So usually we meet on the last Wednesday of the month. But next month we're going to meet on that 4th Wednesday. So just to keep an eye out for that. If you're on the email list, we'll let you know through the email. If you're not already on there, I'll put that in the chat as well. You can get onto our email list. Also, don't forget to check out our Facebook group and our Facebook page. And another announcement too, in October, I know it's kind of early, but in October, we're going to have our For Real event, live in-person event. So just stay in touch with us as we give out more information on the exact date and time and location and so forth. Yeah. So just again, thank you so much, Mike. And I just want to highlight that Mike, it's late on his end, so we really appreciate him spending time with us this evening. So thank you again, Mike. And on behalf of WNN, Young, and Gilbert, I just wanted to wish you guys a good night and a good month, and we will talk to you folks later. Please stick around. We're going to have networking in just a few moments. So thank you again, and yeah, have a good night.